You've learned that all transactions affect at least two accounts, and you learned that debits equal credits in every transaction. For most transactions, QuickBooks handles the behind-the-scenes accounting for you. You don't have to assign the debits and credits. QuickBooks does it for you. Next, you learn how QuickBooks handles the behind-the-scenes accounting for various transactions: a check, an invoice, a payment for the invoice, a bank deposit, a bill, and a bill payment. You see this demonstrated using a T account, a common way to see debits and credits. Then, you see the transaction in QuickBooks, including the debits and credits. Finally, you learn to enter a transaction when there is no built-in form or window. This is called a journal entry, where you enter the debits and credits yourself.
Remember, use T accounts to see the debits and credits for a transaction. Let's look at the debits and credits for a check. This is the Write Checks window in QuickBooks. You use this window to enter a check in the next topic. Let's look at the debit or left side of the transaction. You purchased $600 worth of shipping boxes. The shipping expense account increases by $600. The use of the money is shipping. Remember the general rule. Uses are usually debits. This makes sense because debits increase expense accounts. Draw the shipping expense account as a T. Debits appear on the left. Enter the debit of $600 for the purchase. And debits must equal credits. So the use, where the money goes, must equal the source. Let's look at this purchase from the right, or credit side. Remember, you bought $600 worth of shipping boxes. You pay for the boxes from your checking account, so the balance decreases. The checking account is the source, where the money came from. Remember the general rule. Sources are usually credits. This makes sense because credits decrease asset accounts. Here's the checking account represented as a T. Remember, credits appear on the right. Enter the credit of $600 to show the money coming out of the checking account. Now let's bring back the other side of the transaction. The use of the money is shipping expense. This is represented on the left side, the debit. Note that the debits equal the credits. In the next topic, you learn how QuickBooks makes this entry for you. Business was so good you had to buy boxes to ship more doorknobs. You learned that this transaction debits shipping expense and credits the checking account. Let's see how QuickBooks handles this transaction. Click the Write Checks icon. Use the Write Checks window to enter the transaction. No need to enter debits and credits. Click the Pay to the Order of drop-down list and select the vendor, Bills Boxes of Boxes. Enter the amount, $600. Under the Expenses tab, click on the first line below Account. Click the Account drop-down list to display the list of accounts from the chart of accounts. Select the expense account, Shipping. Let's view this transaction using what you learned in Chapter 1. First, the source, or where the money came from, is the checking account. Second, shipping expense is the use, or where the money went. You recorded who was involved, Bills Boxes of Boxes, and the date of the transaction. Click Save and New to record the transaction. Click Previous to display the check again. Here's an advanced technique that allows you to view the debits and credits for any transaction. Hold down the Control key and press Y on your keyboard. QuickBooks displays the Transaction Journal Report. This shows the journal entry QuickBooks makes behind the scenes. Here is the debit and the credit. Use the Control and Y key to see the journal entry QuickBooks enters for any transaction. You learned how QuickBooks debits and credits accounts when you enter a check. Now you learn about the debits and credits for an invoice. In QuickBooks, the behind-the-scenes accounting is a little more complicated for invoices. Let's look at a sample sale using an invoice. First, let's look at the credit or right side of the transaction. Buildem just did another world-famous doorknob installation. You charge $59.95 an hour for doorknob installations. You need to invoice a customer for 10 hours of installation. The service income account should increase by $599.50. The source of the money is service income. Remember, sources are usually credits. This makes sense because credits increase income accounts. First, draw the service income account as a T. Remember, credits appear on the right. Enter the credit of $599.50 for the sale. That's the credit, but remember, credits must equal debits. The source of the money must equal the use, or where the money goes. Where did the money go? Let's look at this sale from the left side, or debit side. Remember, you sold 10 hours worth of knob installations. Your service income increased by $599.50. The use, or where the money goes, is accounts receivable. This is an asset because your customer owes you the money. Uses are usually debits. This makes sense because debits increase asset accounts. Here's the accounts receivable account represented as a T. Remember, debits appear on the left. Enter the debit of $599.50 to show the customer owes the money. Now let's recall the other side of the transaction. The sale is on the right side, the credit. Note that the debits equal the credits. In the next topic, you learn how QuickBooks makes this entry for you. Let's create an invoice in QuickBooks. Click the Create Invoices icon. You took a phone order from Brad's House of Magic. Click the Customer Job drop-down arrow and select Brad's House of Magic. Enter the line item. Click the Item drop-down arrow and select Knob Install. It took 10 hours. Press Tab. Here's the issue: Knob Install is not an account. It's an item. But this $59.95 should flow to the service income account. How does QuickBooks do this behind the scenes? QuickBooks requires that you set up any line item on a purchase order or sales form as an item. When you sell knob installs, how does this price affect the service income account, and in turn, the profit and loss statement? The answer is on the item list. Click Save and Close to record the invoice. Click the Items and Services icon. Items handle the behind-the-scenes accounting for you. An item points the dollars on the invoice to the right account on the financial statements. How do you know which account the item points to? You enter this information when setting up items. Double-click Knob Install to edit the item. The account field specifies the account that is credited when you enter an item on a sales form. Knob Install points to service income. You can point items to any account on the chart of accounts. Let's see how these dollars flow to the profit and loss statement. Run the profit and loss by choosing Reports, Company and Financial, Profit and Loss Standard. Click the Dates drop-down arrow and select this fiscal year to date. QuickBooks shows the service income account and the total dollars of all items sold that point to that account. What about the debit side of the transaction, where the money went? Click the Create Invoices icon. Click Previous to display the invoice. Every time you enter an invoice, QuickBooks automatically debits accounts receivable. To demonstrate this, hold down the Control key and press the letter Y. Scroll to the right to see the amounts listed as positive and negative. QuickBooks lists debits as positive numbers and credits as negative numbers. Let's modify this report to show the amounts as debits and credits. Click the Customize Report button. Under the Display tab, scroll down the columns list. Click once on Debit and Credit to display these columns, and click on Amount to remove the column from the report. Click OK. Scroll to the right. QuickBooks debits accounts receivable for the amount and credits service income for the same amount. Each time you enter an invoice, QuickBooks automatically debits and credits the appropriate accounts. Close the report and the invoice. In the next topic, you learn about customer payments. The mail just arrived, and Brad's House of Magic sent you a check for the doorknob installations. And finally, let's learn about the accounting for a customer payment. Here is the Receive Payment window in QuickBooks. You use this window in the next topic. First, let's look at the accounting involved. Begin with the left or debit side. You receive the payment from the customer. The check is for $599.50. You don't take the money to the bank right away. Instead, you place it in a drawer, metal box, or on your desk with other checks you'll deposit later. QuickBooks has an account for this called Undeposited Funds. So, the Undeposited Funds account increases by $599.50. The use, or where the money goes, is undeposited funds. Remember the general guideline learned earlier. Uses are usually debits. This makes sense because debits increase asset accounts. Now, draw the undeposited funds account as a T. Remember, debits appear on the left. Enter the debit of $599.50 to show you received the money. Debits must equal credits. The use, or where the money goes, must equal the source, or where the money comes from. Where did the money come from? Remember, you received $599.50. Your customer no longer owes you this money, so accounts receivable decreases by $599.50. That means the money is coming from accounts receivable. That's the source. Sources are usually credits. Credits decrease asset accounts. Draw a T to represent the accounts receivable account. Remember, you are decreasing the asset, so you credit the account. Enter the amount on the right side. Now let's bring back the other side of the transaction, the use, or where the money went. Undeposited funds. Your accounting is correct. Debits equal credits. In the next topic, you learn how QuickBooks makes this entry for you. Let's see how QuickBooks handles the accounting when you receive the check from Brad's House of Magic. Follow the workflow on the home page to avoid mistakes caused by performing tasks in the wrong order. You entered the invoice to Brad's House of Magic in a previous topic. The next step is to enter the customer's payment. Click the Receive Payments icon. Use this window to enter payments from customers with outstanding balances. Start typing the customer job or name, B in this case, and QuickBooks automatically quick fills Brad's House of Magic. Press Tab and QuickBooks displays the customer's unpaid invoices in this section of the window. The amount of the check is $599.50. QuickBooks is set to apply this payment automatically. That means if this amount equals any unpaid balance, QuickBooks automatically applies the payment by placing a check mark to the left. If the payment does not match an open invoice, QuickBooks applies the payment to the oldest invoice first. Press Tab, and QuickBooks applies the payment for you. Select Check. And the check number is 3232. Where does QuickBooks put this payment of $599.50? To find out, choose Edit, Preferences. Click the Payments icon. Click the Company Preferences tab. Note that QuickBooks uses undeposited funds as a default deposit to account. You could uncheck this preference and choose the account to use in the Receive Payments window. But real-world training recommends you leave this preference checked. Click OK. And click Save and New to record this payment. Let's see how QuickBooks accounted for the payment. Click Previous to see the payment. Then hold down the Control key and press the letter Y. QuickBooks debits undeposited funds for the amount of the payment and credits accounts receivable for the same amount. You enter payments in the Receive Payments window, and QuickBooks automatically debits and credits the appropriate accounts. Now you are ready to make the bank deposit. It's time to make your daily bank deposit. Let's look at the accounting for a deposit. This is the Make Deposit window at QuickBooks. Let's review the accounting. Begin with the left or debit side. You deposit the check received from Brad's House of Magic, together with other checks and cash received that day. The total deposit is for $909.40. So, your checking account increases by $909.40. The use, or where the money goes, is the checking account. Remember the general guideline learned earlier. Uses are usually debits. This makes sense because debits increase asset accounts. Draw the checking account as a T. Remember, debits appear on the left. Enter the debit of $909.40 to show the increased balance in your checking account. Debits must equal credits. The use, or where the money goes, must equal the source, or where the money comes from. Where did the money come from? Let's look at this transaction from the other side, the right or credit side. Remember, you deposited checks and cash of $909.40. The money came from your drawer, cash box, or wherever you keep money before you make a deposit. QuickBooks calls this undeposited funds. That means the source is undeposited funds. Apply the general guideline. Sources are usually credits. Credits decrease asset accounts. Draw a T to represent the undeposited funds account. To decrease the asset account, you credit the account. Enter the amount on the right side. Now let's look again at the other side of the transaction, the use, or where the money went. This is your checking account. The accounting is correct. Debits equal credits. In the next topic, you see this behind-the-scenes accounting in QuickBooks. The next step is to record the deposit. Before we do this, let's see how much is in your bank bag. Click the Chart of Accounts icon. The balance in the undeposited funds account is $909.40. Now it's time to make the deposit. Click the Home page to bring it to the front of the screen. Then click the Record Deposits icon. QuickBooks opens the Payments to Deposit window. This window shows the payments received into undeposited funds. This should match the payments in your bank bag or cash drawer. Click Select All to deposit all of the payments. Then click OK. QuickBooks displays the Make Deposits window. This column shows that the payments are coming from undeposited funds and being deposited into the checking account. There's one more item to consider. Before recording this deposit, hold down the Control key and press Tab twice to review a couple of account balances in the Chart of Accounts. The undeposited funds account has a balance of $909.40. The checking account has a balance of $8,642.15. Remember, you are now making your real bank account deposit. Notice how the QuickBooks balances change to match the real bank activity. Click the Make Deposits window to bring the deposit to the front. Click Save and Close. Let's look at the account balances again. The undeposited funds account has a balance of $0. That makes sense because you just made the bank deposit. The checking account has a balance of $9,551.55. Now let's look at the behind-the-scenes accounting. Click Record Deposits. Click Previous to display the deposit. Use your behind-the-scenes trick. Hold down the Control key and press the letter Y. QuickBooks debits the checking account for the amount. This is the use or where the money went. And QuickBooks credits undeposited funds. This is the source or where the money came from. The debits equal the credits. Record transactions using the easy-to-understand forms and windows, and QuickBooks handles the accounting for you. When you receive an invoice from a vendor or supplier, it's called a bill in QuickBooks. In this topic, you learn the accounting for a bill. Use the Enter Bills window to enter vendor or supplier bills. But first, let's learn the accounting behind a bill. Let's begin with the left or debit side. You bought 50 doorknobs at a cost of $30 each. They're very nice doorknobs. Doorknobs increase the inventory asset account. They are an asset until you sell them. So the use, or where the cost goes, is the inventory account. Remember the general guideline learned earlier. Uses are usually debits. This makes sense because debits increase asset accounts. First, draw the inventory asset account as a T. Debits appear on the left. 50 doorknobs at $30 equals $1,500. Enter the debit of $1,500. Remember, debits must equal credits. The use, or where the money goes, must equal the source, or where the money comes from. Where did the money come from? How did you pay for the doorknobs? Let's look at this transaction from the other side, the right side. Remember, you bought 50 doorknobs at $30 each, but you have not paid for them yet. You owe the money to a vendor or supplier. So accounts payable increases by $1,500. That means the source is accounts payable. Apply the general guideline. Sources are usually credits. That makes sense because accounts payable is a liability, and credits increase liability accounts. Draw a T to represent the accounts payable account. Credit the account to increase the liability. Enter the amount on the right side. Now let's redisplay the other side of the transaction, the inventory asset account. The accounting is correct. Debits equal credits. You see this transaction in the next topic. Let's enter a bill in QuickBooks. Click the Enter Bills icon. Let's enter a bill for doorknobs. Click the vendor drop-down arrow and select Supply a Lot, Inc. The bill number is 878. This is the invoice number assigned by Supply a Lot. The amount due is $1,500. Supply a Lot gave you terms of net 30. So QuickBooks calculates the due date as May 1st, 2015. When you enter a bill or check, you have the choice of using the Expenses tab or the Items tab. Use the Items tab for only two reasons. 1, to assign a cost to a job. 2, if you are buying inventory. For any other costs, use the Expenses tab. In this case, you bought inventory items. Click the Item drop-down arrow and select Doorknob. You bought 50 doorknobs. QuickBooks automatically enters the cost. You entered this information when you set up the item. QuickBooks calculates the total cost, $1,500. Click Save and New to record the bill. Now let's look at the behind-the-scenes accounting. Click Previous twice to display the bill. QuickBooks automatically credits accounts payable whenever you use the Enter Bills window. To demonstrate this, hold down the Control key and press the letter Y. Scroll to the right to see the amounts as positive and negative. Customize the report to use debits and credits. Click the Customize Report button. Under the Display tab, scroll down the Columns list. Make sure that debit and credit are checked so that these columns will be displayed. And make sure that amount is unchecked so that it will not be displayed on the report. Click OK. Scroll to the right. QuickBooks credits accounts payable for $1,500 and debits inventory for the same amount. Remember, QuickBooks debits inventory because the doorknob item points to this account. Each time you enter a bill, QuickBooks automatically debits and credits the appropriate accounts. Unfortunately, you eventually have to pay bills. In this topic, you learn the accounting for a bill payment. Always use the Pay Bills window to pay bills in QuickBooks. You learn how in the next topic. First, let's learn how to account for a bill payment. Let's begin with the left side of the transaction, or debit side. You paid a vendor with a check for $2,200. You owe less money, so accounts payable decreases. The use of the money is to decrease what you owe, accounts payable. Use the general guideline. Uses are usually debits. This makes sense because debits decrease liability accounts. You owe your vendor less money, so accounts payable should decrease. Draw a T to represent the accounts payable account. Remember, debits appear on the left. Enter the debit of $2,200 to show you owe less money. Debits must equal credits. The use must equal the source. So, where did the money come from to pay the bill? Let's look at this transaction from the other side, the right side. You used a check to pay the vendor or supplier. So your bank account decreases by $2,200. The source is your bank account. Apply the general guideline. Sources are usually credits. That makes sense because credits decrease asset accounts. Draw a T to represent your bank account. Remember, you credit an asset to decrease the balance. Enter the amount on the right side. Now let's bring back the other side of the transaction. The accounting is correct. Debits equal credits. You learn how QuickBooks handles this transaction in the next topic. Let's pay the bill from Supply a Lot. Following the home page, click the Pay Bills icon. The Pay Bills window lets you select which bills to pay and set various options for those payments. The first option is which bills appear in the window. Bills due on or before a certain date, or all bills. Let's show all bills in the window. Also, choose how QuickBooks sorts bills in this window. Click the drop-down arrow and choose to sort the bills by vendor. In this section of the window, select the bills to pay. Click once on the box in the leftmost column to select a bill for payment. Scroll down to the bill from Supply a Lot. Click once in the box to select this bill for payment. Select the payment method in this section of the window. You paid this bill with a check. Select the payment account in this section of the window. In this case, where the money is coming from. The source is the checking account. QuickBooks shows the ending balance in the checking account after paying the bills. This helps you pay only those bills you can afford. Before paying this bill, let's review two account balances. Choose Company, Chart of Accounts. Accounts Payable has a balance of about $49,709. The checking account has a balance of about $9,551. Click on the Pay Bills window to bring it to the front. When you click Pay Selected Bills, QuickBooks records the accounting transaction and creates the bill payment check. The Payment Summary window shows the bill you just paid. Click this button to print checks now. In this case, click Done to print checks later. Now let's review those account balances again. Accounts Payable has a balance of about $48,209. It decreased because you paid the bill. The checking account has a balance of $8,051. It also decreased because you spent money to pay the bill. Let's look at the debits and credits for the payment. Double-click the checking account to open the register. Click on the bill payment to Supply a Lot. Hold down the Control key and press the letter Y. QuickBooks credits the checking account for $1,500. Remember, this is the source of the money. And QuickBooks debits accounts payable. This is the use of the money. the debits equal the credits. In the next topics, you enter debits and credits directly as journal entries.
You've learned how QuickBooks automatically enters debits and credits for the most common transactions. However, there are some situations when you enter debits and credits yourself. This is called a journal entry. There are 3 reasons why you may enter journal entries into QuickBooks. Number 1, to enter transactions that you can't enter with a built-in form. For example, use the check form to enter a handwritten check in QuickBooks. To enter an invoice, use the invoice form. But what about a transaction like depreciation? Most editions of QuickBooks don't have a built-in QuickBooks form or window for depreciation. Or what about a transaction like amortizing prepaid expenses? There's no built-in QuickBooks form or window for amortizing prepaid expenses either. When there's no built-in form, use a journal entry. Number 2, to correct errors. For example, your accountant found an error that affected 100 individual invoices. Rather than correcting each invoice, your accountant prepares one journal entry to correct all 100 invoices. Number 3, to make year-end adjustments. The accountant might give you a list of entries after they review your books. Usually, you enter year-end adjustments with a journal entry. In the following topics, you learn the debits and credits for depreciation. You then enter this transaction as a journal entry in QuickBooks.
During this topic, you learn the accounting for depreciation. For this type of transaction, you enter the debits and credits using the Make General Journal Entries window. First, let's talk about depreciating a fixed asset. Fixed assets include furniture and equipment. These assets last more than 1 year. Instead of recording the cost of the asset as an expense in the period you bought it, depreciation spreads the cost to each period in which it helps to generate revenue. Remember the matching principle. Depreciation is complex, and the explanation you learn is simplified for non-accountants. An accountant should calculate your depreciation and tell you when to record the transaction. Suppose you have this fancy doorknob polishing machine, the Shine-O-Matic. You will use it for many years, so your accountant has told you to enter depreciation expense every month. First, let's look at the left or debit side of the transaction. You depreciate the fixed asset by $250 per month. The depreciation expense increases by $250. You use the machine, so the use, or where the value goes, is the depreciation expense account. Remember the general guideline learned earlier. Uses are usually debits. This makes sense because debits increase expense accounts. Draw the depreciation expense account as a T. Remember, debits appear on the left. Enter the debit of $250 to show the expense of using the Shine-O-Matic machine. Debits must equal credits. The use, or where the value goes, must equal the source. Where did the money or value come from? Let's look at this transaction from the other side, the right or credit side. Remember, you depreciate the fixed asset for $250 this month. The value came from the fixed asset, so the fixed asset decreases by $250. Instead of using the actual fixed asset account, accountants use a separate asset account called accumulated depreciation. So, the source is accumulated depreciation. Apply the general guideline. Sources are usually credits. That makes sense because credits decrease asset accounts. Draw a T to represent the accumulated depreciation account. Remember, credit the asset account to decrease the balance. Enter the amount on the right side. Now let's bring back the other side of the transaction, the use. The accounting is correct. Debits equal credits. In the next topic, you enter this transaction in QuickBooks. Your accountant just sent you instructions to enter a journal entry to depreciate your Shine-O-Matic. Click the Company menu and select Make General Journal Entries to display the Journal Entry window. This is Journal Entry number 8. QuickBooks automatically numbers the journal entry. For the first line of the entry, click the Account drop-down list and select Depreciation Expense. This is a debit for $250. Type a memo, Monthly Depreciation. For the second line of the entry, click the drop-down list and select Accumulated Depreciation. This is a credit for $250. QuickBooks enters the amount for you. Click Save and New to record this journal entry. If you do not have a strong accounting background, real-world training recommends that you enter only journal entries provided by your accountant.